Shares of Domino are down sharply after the pizza chain reported weaker than expected U.S. same-store sales growth. There's the stock down about 3%. Revenue and profit in its latest quarter also missed estimates. On the upside, the positive side, it notes it was the 31st consecutive year of same-store sales growth in Domino's international business. To talk about this, we're joined by Danilo Gargiulo, senior analyst with Bernstein in New York. Danilo, thank you very much for joining us. I've read some of your notes, and you see some. You liked part of what you saw in these numbers, particularly growth in the international segment and cost control. Why don't we begin there?
Yeah. So first of all, I would say on the international side, it was a nice rebound, probably in line with what we're seeing from other QSR companies. But it's a nice rebound that could be lifting some of the uncertainty on the stock that was stemming from some master franchisees not fully following the recipe that Domino's corporate was trying to launch in the US and worldwide. So now we have some reacceleration in some of these international markets that could be potentially helping at least offset some of the weakness that we see on the delivery side in the United States. Still some uncertainty on the units on the international side, but at least it's a better setup compared to what we thought entering into the quarter. But more importantly, as you pointed out, I think the company was demonstrating that even if the retail sales are coming in a little bit weaker than expected, there is some good cost control mechanism that enable them to maintain the profile on the operating income growth anyway. And so this kind of balance between sales and profitability is going to be the key for investors in Domino's even in 25.
How big is that international segment, Danilo? The U.S. obviously is the biggest market. How big is the international segment?
Right, and the key question for Domino's is how important is that going to be, right? Because part of the multiple, or part of the reasons why investors are willing to increase their expectations on Domino's going forward is the growth that you can expect from the international market. As you pointed out in the intro, this is the 31st consecutive year of same-store sales being positive in international markets. And more importantly, there is a significant potential from a unit growth standpoint, with the two primary markets being China and India still under tap from a QSR per capita basis. And so the key is stabilizing the international markets is more relevant for the multiple that you might be assigning to Domino's. That's why it's so critical that they continue to convince franchisees about the success of their more strategy that they launched here in the United States.
In your note, you highlight that supply chain margins at Domino's continued to outperform. Explain that metric to us, supply chain margins, and why that's important to your thinking on this stock.
Yeah, so Domino's, just like if you think about maybe Tim Hortons or Starbucks from a different category, they own their supply chain. Essentially, they're selling their products or their food items onto the franchisees, and so it's very important they continue to scale in terms of orders and they continue to scale as a business, because in that case, they could be procuring the ingredients at a lower cost. And then that means that also when they pass it on to franchisees, that results into higher profitability for them, which again creates a virtual spiral in them willing to open up even more stores going forward. Now, the supply chain efficiency that we were mentioning in the call was driven by some procurement efficiency that they've been able to unlock this year, just in line with what they have done also in the past years. Again, demonstrating that the more they scale, the more they order increase over time, the more they're able to guarantee even better prices for their franchisees and therefore allow for higher profitability going forward.
I understand also from your note that the company is going to launch stuffed crust pizza in March. How could that be material to earnings performance?
Well, that's definitely an upside that bulls on the stock are looking for. Management wouldn't confirm today, what's about to be launched for competitive reasons, but I think it's been highly circulated that this is the new introduction. And one thing to remember is Domino's never launches limited time offers. They tend to launch permanent item or permanent addition to their menu because they believe that once they make this investment into food, it can help the entire system over time, right? It's a multi-quarter type of productivity gain that the stores could see, as well as consumers might be gaining appreciation and awareness of this new introduction just over time. So back to your question, is that going to be material? That is definitely a hope. Certainly, it has been quite successful if you look at other markets like in the United Kingdom, where the stuffed crust has been quite popular, or in China, as an example. So there are some high or elevated expectations in the US, but I don't think this is the only catalyst for them into 2025.
How is Domino's performance in terms of market share? Is it still gaining market share? And and which market do you look at it in, the pizza market or the fast food market more broadly?
Yeah, that's an excellent question. So from a pizza market standpoint, management called out that they've gained another 1% in market share this year, which is in line with the average since 2015. Now, I will claim that, to some extent, the definition of market should be augmented over time, right? Because back in the day, there was only one category that was able to deliver, maybe two categories able to deliver food, and they were typically the pizza and the Chinese category. Today, the definition of delivery should be broadened. And so who do you consider being a peer or competitor today should probably be revised. I don't know if Domino's, if you look at this other metric, like a more expensive definition of market, I don't know if Domino's actually held the market share compared to a few years ago, because we tend to see some very fierce competition regarding value and promotional activity throughout the QSR markets, but even more broadly from the fast casuals. Even if they do not promote that much, they're able to offer real value to consumers. And that's why we've seen places like Wingstop or Cava or Chipotle gain so much market share over the past couple of years.
Okay, so you're fairly positive on the performance in the most recent quarter and the company's performance more broadly against its competitors and peers, but you have a market perform rating on the stock that's broadly the same, similar to a hold, and your price target is $440 per share. That's basically where the stock is right now. What would it take for you to become more positive on the share price? You must feel the stock is essentially fairly valued right now.
Yeah, and I think, look, we should probably discern between the performance of the company, which I think was good considering their ability to operate in this very tough environment. And then what do we believe on the stock, driven by the category in which Domino's is playing. So I actually don't have a very positive outlook on the pizza category as a whole, right? So Domino's is trying to do their best within their ability, but clearly the pizza category is under a lot of pressure. We have more competition, as I said before, from a delivery standpoint. The category is not a preferred category if you're moving on to a health and wellness or increased adoption of GLP-1 drugs over time. And more importantly, we start to see an elevated level of promotionality across other categories as well, which might be creating some sales pressures into the pizza category. So within this operating environment, Domino's tried to do their best, and their cost control mechanism has been pretty solid. But once again, the environment itself is very tough. So the multiple need to come down a little bit more for us to become more positive on the name, right? Reflecting more this new reality in which Domino's is operating, which is a very different reality of the Domino's in the kind of mid-2010s, which was deserving a high 20 multiple, right? We think it needs to be broadened down to the new reality of maybe low 20s multiple.
Danilo, thank you very much. Danilo Gargiulo is senior analyst with Bernstein in New York.